garages across the country, and it doesn't always look like a crisis. In fact, it often looks like a brand new SUV with tinted windows or a full-size pickup truck with all the bells and whistles. The kind of car that smells like fresh leather and comes with built-in cameras on every corner. The kind of car that cost more than many Americans used to pay for a starter home. You've probably noticed it. Maybe your neighbor just rolled up in an $80,000 Tahoe. Maybe your coworker is bragging about the new F-150 with a monthly payment that sounds more like a mortgage. And you're wondering, like a lot of people are, how are they really affording this? Well, here's the thing. They're not. At least not in any real sense of the word. Because today, nearly 20% of all new car loans come with monthly payments over $1,000, according to data from Edmunds. Let that sink in. 1 in 5 people buying a new car is signing up to hand over $1,000 every single month for 7 years. It's not like they're suddenly flush with cash. Quite the opposite. These massive car notes are becoming more common for average buyers, many of whom are already financially stretched thin. So how did we get here? And more importantly, why are so many people willingly signing up for this? Let's start with the size of the loan itself. The average amount financed for a new car has hit a record high of $42,388. That's not the sticker price, that's the amount people are actually borrowing. For context, that's more than many people make in a year, and that's not even counting gas, insurance, registration, and maintenance, most of which tend to go up the more expensive the car is. Insurance companies charge way more to cover a new vehicle. Registration costs usually jump too. And of course, you'll want to keep it looking sharp. So now you're paying a premium for frequent car washes or regular detailing. Even the tires are pricier. Those 22-inch wheels might look great, but replacing them isn't cheap. To make those monthly payments more affordable, more and more people are turning to 84-month loans. That's a 7-year commitment to the same car, same debt, same monthly payment. Over 22% of borrowers chose this option in the second quarter of 2025, a number that's nearly double from 6 years ago. Stretching out the loan term may make the payment look smaller, but it doesn't make the car cheaper. In fact, it makes it much more expensive in the long run due to interest. With an increase like this, it won't be long before everyone's signing up for a 10-year car loan. Speaking of interest, rates remain high. The average interest for a new car loan is 7.2%. That's a big jump from the near zero interest era of the past. Those tempting 0% financing offers that used to be everywhere, they've all but disappeared, now accounting for less than 1% of loans. So unless you're paying in cash, which most people aren't, you're likely financing your car at a steep cost. Let's do some basic math. The average new car is $49,000. Suppose you finance that amount at 7.2% interest over 84 months. That's roughly $750 a month, not including taxes, fees, or add-ons like gap insurance, extended warranties, and service contracts. Add those in, and it's easy to see how payments top $1,000, especially if someone buys a mid-size SUV or a truck. And many do because they've been told they need something safe for the kids or capable of hauling weekend toys. It's not just the high loan balances or the long terms that are a concern. It's the fact that so many people are doing it without a second thought. More than 1/4 of all trade-ins for new cars come with negative equity. That means the car buyer still owed more on their old vehicle than it was worth when they handed over the keys. And that difference, often thousands of dollars, doesn't disappear. It gets rolled into the new loan, making an already expensive vehicle even more costly. This is where the cycle starts to feel like quicksand. Let's say you owe $20,000 on a trade-in, but it was only worth $15,000. Now you're financing $54,000 instead of $49,000. And when you do eventually go to trade that new car in, you'll be underwater again, because the value of your car drops faster than you're paying it off. It becomes a loop of perpetual debt with no clear off-ramp. What makes this all the more frustrating is how normalized it's become. Social media is full of people showing off their new rides, never mentioning the 7-year term, 7% interest rate, the $5,000 down payment they barely scraped together, the $500 monthly insurance premium, or the negative equity cycle they're now stuck in. Families with average incomes are stretching themselves just to get to work, bringing home a paycheck, and watching a big chunk of it disappear each month on a car loan. When a 22-year-old rolls up in a $90,000 pickup truck, the reaction shouldn't be admiration, it should be concern. Even if he's pulling in a decent income, it's hard to understand why someone would pour that much money into a depreciating asset so early in life. That truck is losing value by the day, while that same money, invested wisely, could have laid the foundation for serious financial freedom just a few years down the line. What looks like success at first glance often falls apart when you see what's left after the bills are paid. In reality, a brand new, expensive car isn't typically a sign of wealth. It's a red flag. It's not a financial achievement, it's financial malpractice dressed up in leather seats and huge wheels. Take a married couple with a combined income of $120,000 per year, about $10,000 a month before taxes, maybe $7,000 to $8,000 after taxes. Let's say one spouse has a $1,200 car payment and the other has a $700 payment on a slightly older model. That's $1,900 going out every month, not including insurance, gas, or maintenance. For a lot of households, that's more than the rent or mortgage. The car has become the new house, but unlike the house, it appreciates the second you drive it off the lot. And then there's the opportunity cost. If, instead of spending $1,000 a month on a car, you invested that money at 10% annual returns, how much could you build over time? Over just 10 years, that's nearly $200,000 before inflation. In 20 years, it's almost $700,000 before inflation, in never increasing contributions. That's the real price of the $1,000 car payment. It's not just what you pay now, but what it keeps you from building in the future. Yes, inflation matters, but your contributions will typically rise with it too. Where this situation becomes even crazier is when you see these expensive trucks and cars parked in front of $400,000 homes, often two of them. Just one car is worth a big chunk of what that house is, and it just makes you wonder how backwards our priorities have gotten. A house is something that can go up in value, give you stability, and help build long-term wealth. A car, it's dropping in value every single year. But still, people are out here with payments that are almost as high or higher than their mortgage, all to look good pulling into the driveway. At that point, it's less about getting from point A to point B, and it's more about showing off. And for a lot of people, that need to look successful is wrecking any real chance of actually becoming successful. What's especially dangerous about the $1,000 car payment trend is that it doesn't always feel reckless in the moment. Monthly payments are sneaky. It's not like you're dropping $49,000 all at once. You're just paying a manageable amount each month. But over time, those manageable amounts snowball into a mountain of debt, stress, and missed opportunities. And it's not just the number on the loan document, it's the mental load that comes with it. The feeling of always being behind, the fear of unexpected repairs, the weight of another financial obligation that never seems to go away. Imagine this. Instead of dropping $1,000 or more every month on a car payment, you choose something more reasonable, say a car with a $500 payment. It's still a solid vehicle, just without the financial baggage. That extra $500 you're not spending, if you invested it each month, you'd be nearly maxing out a Roth IRA every year. In that one choice, the choice to drive something a little more affordable could be the difference between struggling later in life and having a comfortable, secure retirement. You're balancing living for today while also being responsible. It's not about depriving yourself, it's about prioritizing your future over impressing strangers in traffic. The average price of a new car has definitely gone up a lot, but it's not just because of inflation. What people expect from their cars has changed too. Stuff like lane assist, automatic braking, blind spot warnings, things that used to be fancy extras are now pretty much standard. Heated and cooled seats, big touchscreens that connect to your phone, fancy sound systems, and those bigger wheels have become the norm. And it's not just about added features. Car makers have steadily made the same models bigger and more loaded over time. So in many cases, people aren't just paying more because of price hikes, they're paying for larger vehicles packed with the tech and comforts we've come to expect. 10 years ago, $1,000 car payments sounded insane. Today, it's just another Tuesday. The question